Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's talk about the upcoming ECB interest rate decision due on Thursday. This comes in the midst of a whole host of interest rate decisions from the likes of Bank of Japan early in the week. And we've also got the Bank of Canada coming out with their decision as well. But the ECB is an interesting one because ultimately, from an economic standpoint, things look like the ECB should really be gearing up for a cut in the near future. But the tones coming from different members would insinuate otherwise. Let's look at some key statistics to underpin our view for this. So first and foremost, we can see from a PMI perspective, which is a relatively leading indicator for economic health, the reading for the Eurozone remains well below that 50 threshold that separates expansion, which is above 50, from contraction, which is below 50. Manufacturing, as you can see in the middle, continues to be the area that really stifles all of these economies. But unfortunately, the Eurozone also sees services in contraction, and as a whole, that composite reading of 47.6 has got to be worrying for the ECB. Bear in mind, we also see this week PMI numbers coming out from the Eurozone and Europe and the US as a whole. But these December numbers are unlikely to change massively. I don't think we're going to get anywhere near that 50 mark anytime soon. So we're looking at a contractionary environment for Eurozone businesses, more so than the likes of the US and the UK, which are faring relatively well. So if we're looking at the sort of comparative environment for the likes of Federal Reserve, the Bank of England, and the ECB certainly has a lot more of a worrying picture to really deal with and weigh up when it comes to the economy. In terms of the sort of trajectory, it's interesting here if you see the breakdown comparing the likes of the UK to the Eurozone. The UK over recent months has really been pushing onwards and upwards in terms of that composite PMI number, really driven by strength in the services sector, whereas the Eurozone has continued to trundle along well below that 50 mark. So the picture remains worrying for the ECB. Then looking at things from an inflation standpoint, the Eurozone inflation rate is at 2.9%. That's well below the likes of the US and the UK. Certainly, it's above that Japanese reading, but the Eurozone has this environment where its inflation rate is relatively low, whereas the picture from an economic standpoint is relatively concerning. And so that would point towards the likes of the ECB being the central bank that should probably lead the way when it comes to easing. Another way of looking at it is shown here. So the top part of this chart shows you the monthly trajectory that we have been seeing. Those light blue bars, you can see some really chunky prints for February, March, April. And that really highlights the fact that once those readings are stripped out, soon enough, we're likely to see Eurozone inflation come down in a very meaningful manner. And that's exactly how I've shown it at the bottom. So the 8-month annualized figure. So essentially, if you take the last 8 months and you project that into an annual figure, what would that look like? And therefore, this paints a picture of where will Eurozone inflation be by May time, according to the trajectory over the last 8 months. And as things stands, that looks like 1.14. So we're looking well below that 2% target. And so the Eurozone has inflation looking like it's on a trajectory that's going to go well below target, and the economy in a difficult way. So soon enough, they have to really start to shift, because it looks like by May time, that we could see inflation potentially closer to 1 than 2. In terms of market expectations, this comes from Refinitiv. We have seen an expectation at the moment that April will be the first rate cut. Of course, we don't necessarily have one in June, so we're looking at May to potentially be at 1.1%, but we're also expecting to see that figure a month earlier below 2% as well. So that breach below 2% is likely to push the ECB into cutting rates. Markets still expecting 34.2% possibility that we see them holding in April. Of course, we're some way off, and at the moment it looks like we still have question marks around about what's happening in the Red Sea. Is that going to incite a round of inflation? So there still are some question marks, but certainly I think there's a good chance that as we move forward, that 34% is likely to deteriorate. And the question marks around about this meeting are really around about, are we going to see the ECB shifting their rhetoric? The outlook that I have here, I think, is an interesting one to look out for. First and foremost, it highlights the fact that the ECB started from a lower base, but they've also peaked out at a lower level. And so the expectations in terms of market implied rates going forward over the course of 2024 do point towards the European central bankers driving that rate lower and maintaining that significant gap between the likes of the ECB, the Federal Reserve, the Bank of England, and the Bank of Canada. So this is an interesting picture, and whether this comes to fruition or not is going to be particularly interesting. And so what we're going to be looking out for are a number of things, but certainly the outlook for inflation, the outlook for growth, that's going to be important. But the outlook for interest rates will be the most important factor here. Are we going to see them coming out with statements that would indicate that they're preparing to cut rates, or are they going to do what they have been doing recently, which is essentially tout the line of we're data dependent, we need to see inflation moving towards that 2% target for us to know. I think in their mind, they would like to tell us a month in advance, maybe month and a bit in advance of actually cutting interest rates, rather than what's happening at the moment, which is markets getting a little bit ahead of themselves, pretty much pricing in those interest rate cuts. And therefore, the market sort of tightening of financial conditions already starts to reverse before the ECB even take any actions. That's clearly not something they want to happen, and they're trying to take steps at the moment. And the rhetoric around it of late has been one of markets should be cautious because they're overpricing at the moment. And that potential convergence does point towards the potential for some strength. It really depends on whether markets believe it or not. And as things stand, markets aren't believing it because they're pricing in that April cut. Here's a couple of charts that I wanted to bring up. Let me just get this full screen. First and foremost, we're looking at the euro against the Canadian dollar. This is also driven notably by energy prices. So the pullback that we have been seeing came alongside a strong end to the week for energy prices. There is a good chance we see more of that. But certainly, if you look at this recent sort of rebound at the beginning of the year, that looks to have broken now. You could see this as a triple top formation, really. I was going to say head and shoulders, but really the shoulders are near enough in line with the top end here. So that break that we've seen below this 146.34 does indicate the potential for near-term downside. The rhetoric around this Bank of Canada decision, the ECB decision, is going to be a key one here. But now that we've broken support, there's a chance that near-term upside is there to be sold into once again for those looking for a continuation of that breakdown through support. Euro sterling is also another one. This is one I was talking about last week. And certainly the Fibonacci's have near enough come into play here. I mean, look, we came just shy of that 61.8 fib, but I was talking about the potential for it to roll over once again and continue this recent pullback. And that's what has happened. We're starting off a new week by trying to regain some ground, but I think there's a good chance that markets will be able to reflect on the idea that the ECB is pretty much going to have its hand forced if inflation continues on its current trajectory. The reliance on the Europeans for gas prices has been particularly notable given that significant downside we've seen in terms of natural gas prices, which has continued. So near term, if we see a rebound, I think there's still a good chance that we do see this weaken. The ECB tone is likely to be somewhat cautious. They're not going to want everyone to price in loads of rate cuts. Nonetheless, I think it's likely that markets are going to see that fall on deaf ears, and they will expect nonetheless. So as we've seen here, this current respect of that 61.8 Fibonacci level, this zone here, I think, is there for this market to roll over once again. I think ultimately the Bank of England, given the fact that we're a lot more geared towards a services sector that has remained strong throughout this whole process, whereas the manufacturing sector, which the Europeans or mainland Europeans are much more reliant on, is looking very weak. The Eurozone picture on an inflation front looks like we're going to see a breach back below that 2% target by April. And therefore, the likeliness is that we see the ECB move first. And given the fact that they're at a lower base already, I think there is cause for expectation that we're going to see potential further downside for this market. So near-term rebound, I don't think is likely to last unless we break this 862 mark. I think this zone here is essentially a pullback retracement phase before we continue that downtrend that we've been seeing dominate throughout the beginning of this year, but also earlier at the back end of last year as well.